Welcome to Thoughts on the Market. I'm Mike Wilson, Chief Investment Officer and Chief U.S. Equity Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the latest trends in the financial marketplace. It's Monday, September 26th at 11 a.m. in New York, so let's get after it. Last week's Fed meeting gave us the 75 basis point hike most investors were expecting, and similar messaging to what we heard at Jackson Hole a month ago. In short, the Fed means business with inflation and is willing to do whatever it takes to combat it. So why was there such a dramatic reaction in the bond and stock markets? Were investors still hoping the Fed would make a dovish pivot? Whatever the reason, both stocks and bonds are right back to their June lows, with many bellwether stocks and treasuries even lower. As we wrote a few weeks ago, we think investor hopes for a Fed pivot were misplaced, and Chair Powell has now made that crystal clear. Secondly, we noted last week that the only remaining hope for stocks would be if the bond market rallied at the back end on the view that the Fed was finally ahead of the curve and would win its fight against inflation while slowing the economy materially. Instead, interest rates spiked higher, squelching any hopes for stocks. While 15.6 times price-earnings ratio is back to the June lows, that PE still embeds what we think is a mispriced equity risk premium given the risk to earnings. Said another way, with a Fed pivot now off the table, the path on bond and equity prices will come down to growth, economic growth for bonds and earnings growth for stocks. On both counts, we are pessimistic, particularly on the latter as supported by our recent cuts to earnings forecasts. We have been discussing these forecasts with clients for the past several weeks, and while most are in agreement that consensus 2023 earnings estimates are too high, there is still a debate on how much. Suffice it to say, we are at the low end of client expectations. Interestingly, recent economic data have kept the economic soft landing view alive, and interest rates have moved above our rates team's year-end forecast. From an equity market standpoint, that means no relief for valuations as earnings come down. This is a major reason why stocks sank to their June lows on Friday. Ultimately, we do think economic surprise data will likely disappoint again, but until it does, there is no end in sight for the rise in 10-year yields, especially with the runoff of the Fed's balance sheet increasing. As such, our rates team has raised its year-end target for 10-year Treasury yields to 4% from 3.5%. This is a very tough backdrop for stocks and epitomizes our fire and ice thesis to a T. In other words, rising cost of capital and lower liquidity in the face of slower earnings growth or even outright declines. Finally, the Fed's historically hawkish action has led to record strength in the U.S. dollar. On a year-over-year basis, the dollar is now up 21% and still rising. Based on our analysis that every 1% change in the dollar has a 0.5% impact on S&P 500 earnings growth, fourth quarter S&P 500 earnings will face an approximate 10% headwind to growth, all else equal. This is in addition to the other challenges we've been discussing for months, like the payback in demand and higher costs from inflation, to name a few. Bottom line, part two of our fire and ice thesis is now on full display, with rates in the U.S. dollar ratcheting higher just as the negative revisions for earnings appear set to accelerate to the downside. In our view, the bear market in stocks will not be over until the S&P 500 reaches the range of our base and bear targets, i.e. 3,000 to 3,400 later this fall. Thanks for listening. If you enjoy Thoughts on the Market, please take a moment to rate and review us on the Apple Podcast app. It helps more people to find the show.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.